we discussed the layers for crypto. So what are the 4 layers or 5 layers? So if you don't ask me questions, I'll ask you questions. Should I pick on someone? So we know we had layer 1, layer 2, layer 3, layer 4. What are those? Come on.
Yeah, basically, the 0 is Polka, 1.
Okay. Gavin would think Polka is 0.
Yeah.
But we don't have this. So layer 1 is the settlement layer, the basic transaction.
The
Layer 1.
And then you move to the business technologies application towards layer 4.
Thank you.
So that's how you transform from layer 1 to layer 4. And what we also learned is that without layer 1 can exist as it is, but no further layers can exist without having a predominant layer before it. So all the other layers are based on 1 or 2 layers before them. And with layer 4 being the industries and technologies, and layer 3 being the layer 2 being such as Polygon Matic, layer 1 becoming Bitcoin and Ether, and layer 3 being the currency exchanges.
Yeah, no, you summarized it well. That's why, guys, he has a master's unit t-shirt. No, I'm just kidding. So you have layer 1, which is a transaction system. All the layers, that's why you say layer 1 protocol. One, Vijay, please. Thank you. I thought you all had lunch, so I thought I'll have coffee. But so layer 1 is basically the transaction layer, right? So that's why it's called layer 1 protocol. You will hear this a lot. And it's important because the first question I ask for projects when they happen at this layer, what's your layer 1? Because layer 1 gives me an indication for investments or for technology, what is the cost structure? So if you're on Bitcoin and Ether, you might as well be pretty good. Otherwise, your cost structure is going to be pretty high, which means your asset valuation, asset class has to be in line with layer 1. And layer 2 is there to solve the inefficiencies of layer 1. So Tushar, the things that you mentioned, privacy, scalability, all the trilemma issues, we are now subdividing those issues into the different layers. Layer 3 is when we begin to see business applications. So layer 3, think of how many of you are in tech here, microservices. So you have identity, you have stable coins, you have exchanges, you have ERC20, ERC21, NFTs. And layer 4, think of them as aggregators. They're taking a stable coin, they're building an exchange, they're building liquidity pools and saying, you know what, lock your assets, I'm going to issue another asset, or I can take your liquidities, I can take your token and invest them in the best pool, which offers the best yield. And that's all happening at layer 4. For technologists in the room, I think this layering is nothing to do with the business layering of blockchain itself. And by the way, there's layer 0, which is Web 3.0, which is the next issue after this. And people have talked about layer 5, which is very obscure, but to me, the core of the system today, which means I can cite with definite examples, is broken into these 3 or 4 different layers. One of the biggest challenges, which I will pause after this and go to this piece, is this plus layer 1 is foundation of Web 3.0. How many of you have a mobile app that stops working after a year? That you paid for it, but it stops working after a year. You've seen that, right? Why is that? The company went out of business, they stopped paying for cloud services, your data is stuck somewhere, because the whole idea is that you change phones often, they are supposed to keep your cloud and data, they went out of business, you change your phone, next thing you know, everything is gone. And that's foundationally the challenge we begin to see with layer 0 and layer 1, is most of our data is in Amazon and Google and all these other places, which is a foundational disconnect with what we're trying to build. So I'm going to build upon that thought process in Web 3.0 conversation, but this layering is only for layer 1. So when we are building Hyperledger Fabric, we had to address this conversation, Niharika, that you brought up, is the coexistence of permission versus permissionless. We had to say, okay, how do you slice this cake? How do you figure this out? And so we then said, you need to have physical infrastructure layer, all the IT components, the certificate management authorities, the cryptography, the processors, and there's a whole conversation at the hardware level with CPUs and GPUs, and now you have ASIC Generation 5 chipsets, which are providing you the computational efficiency that you need at this layer. And then you have all the stuff around databases, cryptography, and which algorithm elliptical curve, ECDSA, Diffie-Hellman. So all the elliptical curve is a mathematical alternative to simply keeping your keys and your crypto artifacts just increasing in size because that just takes a few weeks to break over time. And then you have the consensus layer, and there were 17 known consensus models. Now there are hundreds, but at the very basic level, they stem from the 3 or 4 fundamental consensus mechanisms. So you have proof of work, which is a truly trustless model because proof of work requires the entire ecosystem to run their computer, and we all have to agree, which is why it's expensive. And then you have proof of practical Byzantine fault tolerance. You don't have to know the technical element of it, but there are a lot of technical papers that discusses the Byzantine problem, which is the 14th century Byzantine era challenge of generals and figuring out who do you trust, who do you don't trust. So you devise a system that assumes bad actors and bad players, and yet you come to a consensus which is definitive and it is trusted, right? And then you have proof of stake, and you have Paxos, and you have Raft, and these are all variation of, or you have delegated proof of stake. All that means, which is still questionable, is if you're in a system and we all have a stake in our economy. You live and we all work, you work in India, I work in the US, we have assets. We want the economy to do well because we have some stake, we have jobs, we have investments, we have a house. We generally have a good tendency to keep the ecosystem healthy and growing. A similar conceptual element for proof of stake is if you have a stake in a network, the chances of you colluding against your own network is minimal. Though we have seen in the real world, people do that all the time. We collude, even though we live in the system. We want to make the best of the system, find loopholes, cheat, fraud, defraud. And the question then becomes is how do we devise a proof of stake, proof of work? And so when I'm looking into layer 1 only, and these are for technical design people in the room and investment people in the room, trust me on this, that the CA community and the reason why I got involved in investing is investors or the banking financial community doesn't get jack of what all this is. And so the question becomes is you're investing into something you don't understand, you might as well go to Las Vegas and gamble. It's not something which is, so they begin to then go after, so you begin to see a lot of technologists, including myself, we move into financial investing space. So we can work with the experts in that area and we can bring our expertise. So there's a cross-pollination of we educating them on this world and them educating on how a fund is formed and how. So I spent like 4 years, I'm happy to either take it offline or discuss this here in terms of what we have done with Portal Asset Management, which is something we founded 4 years back in taking the fundamentals into the first 4 layers and figuring out. And I went through this exercise and I'm happy to show it at the end of today. We evaluated 15,000 tokens, 15,800 tradable tokens, and we distilled them down into 17 categories of tokens. So there are 17 different categories of tokens, which we'll discuss in detail tomorrow. But I came with a portfolio of 25 tokens, which follows my conviction, based on all this knowledge to say, chances are with PBFT, which is Hyperledger Fabric, you cannot scale. You simply cannot scale beyond certain nodes. So if you're building a project in that, chances are you'll not be successful. Or going with proof of stake. So that's why it is not just technical elements of transaction finality or security or consensus. It all is very much tied to, so if you look at Pantera Capital, all these are in $1 billion worth of funds dedicated to crypto, including A16Z. They have a massive amount of technical team who is providing the insight to say, what are the chances of successes, what are the loopholes in these areas? Because unlike transportation, airlines, all the traditional investment categories or industries that we have, which is well known because it's been there for 50 or 100 plus years, with textile or transportation or airlines or trains or whatever it is, we know the cost structures. What we don't know is the cost structure of the implication of choosing the right tech at this layer, which is a foundation. So everything else, so if this layer goes away, this is like anything else, if layer 1 fails, what happens? What happens if Ethereum fails in this transition to Ethereum 2? The ecosystem dies, right? Or ecosystem had to repivot, readjust. And the reason why bridges were created now, and that's why it's so popular, because everybody wants to hedge their bets. So if you have an amazing project on layer 1, layer 2, they begin to now, so example is again, Polygon is there because Polygon is also looking into saying how can we create the same system for, but remember this, Polygon's entire business model is on what? Ethereum 1.0, right? The one that's right now. So that's because it's solving the deficiencies of Ethereum 1.0. But remember, Ethereum 2.0, for those of you who don't know, they're trying to move from a proof of work to a proof of stake. It's solving the scalability challenge, but you're giving up on decentralization to a certain extent. So what happens to,
Why is proof of stake not?
because proof of stake becomes an oligarchical system where suddenly now you're introducing this decentralization by picking the 32 players at random. So your decision making for every transaction is confined to that subset of 32 people among the hundreds of people who are there. So it's not truly decentralized, it's quasi-decentralized because you want to achieve speed. That's why that's the case. So the question for you all who understand Polygon, because it's our crown jewel contribution to the crypto world, what is the success factor of that? Once you move to a completely different economic system, are they solving the same problems? So I think they're pivoting. They're focusing on zero knowledge proofs to provide transparency and everything else. And I think that is something which should go into your calculus as you're evaluating this. And I'll tell you this, as the Indian government talks about taxation and everything else, all this conversation is completely oblivious, but it does matter because proof of work is a utility token. So you need Bitcoin, Ether. Why do you need them? You need them to participate. You need Ether to pay for Ether transactions. It's a gas fee. Gas fee is not in dollars, it's in Ether. You need to pay Bitcoin in fees in Bitcoin because Bitcoin doesn't understand dollars. So that is a utility asset. Utility is something it's not an asset, it's something you need to, it's like a toll mechanism, means of transactions. But if you can take the same asset and stake it with expectation of a return, the banking people in the room, what is it called? What is that called? True, it helps with cash flows, but what is that instrument when you invest something with expectation of a profit? A security. It's a security. So that completely shifts the definition of what an asset is. So how taxation of, for example, utility is different taxation of a security and the legal definition of what that is. That to me is a massive risk because the stroke of a pen, from a legal standpoint, will drive away a lot of the institutional investors, which are 90% or 60% today of the DeFi growth. That's a risk. So when you invest these things, that's the path you got to start looking into so this is not just on paper and, I have knowledge. We have to apply this from this layering mechanism to make sense of this chaotic world that's emerging is how do I block them? How do I put this in this different, and I think the more and more you do this, which I've done this for every single protocol, is go to the basics. What's the business model? What are you solving? What are the founders? What are they doing this? Which it can be a lot of work because there are thousands of tokens coming up on a daily basis. So I have a question before I move on to the next one. Why do we have so many crypto projects? Yeah.
One question.
Go for it.
Like currently SAP,
SIP.
yeah, that also restricts like any manual interference.
Restricts what?
Restricts manual interference.
How so?
Like you can just base like other than IT admin, like you can block the users.
Yeah, somebody has to block it.
Somebody has to block it. Yeah, like IT person, and that would depend on the audit committee or the governance committee. Suppose they are designing the approvals. If suppose blockchain comes there, then will there be any person who can still do the approvals or restrict the?
So you're talking about censorship inclusion. So blockchain's entire thesis of permissionless or trustless models is censorship resistance. The whole point is, which is also Web 3.0's core agenda. The ability for Twitter to take off a US president. I'm not a big fan of Trump personally, but to me, freedom of speech is very, very vital. And even during this COVID, regardless of our opinions and our thought process, freedom of speech is really more important. Because I should be able to say what I want to say. That's the hallmark of any free society. Otherwise, I might as well go live in some other place. So the choice of where we want to live, and I think that censorship has become a big problem in Web 2.0 world. So what you're talking about is, will a corporation or entity, so remember I'm doing business with a bank, and bank can choose to do business with me or not to do business with me. I can sue them if they're discriminatory or if they find a reason, but if your bank shuts you off, well, that's an inconvenience to you. And you have to fight that because now it stops you. If a bank just shuts you for account, that's the big problem for you, right? And so the question is, yes, even an IT admin ability to do that is a problematic element of a system. And in many cases, the business process management that we have devised is not just for movement of containers and shipping containers and supply chain. Business process is also managed for risk controls. So if you look at OFAC list is what US Treasury puts for, so US Treasury every day, especially now with Crimea, Ukraine and Russia, it has individuals, it has companies, it has banks that list as sanctioned entities. So when you do KYC AML, for every transactions, you have to go and verify the sanction, which is growing on a regular basis. And that basically is a mechanism of this example. So SAP and Oracle also make financial systems. Is someone to go and have a workflow to say, there'll be no transaction going in or coming out, or coming in from this entity. So that is driven by this entity. So the question becomes, can you do that in crypto? And this is a very pertinent question because this question we are raising as the Russian banks and Russian players and oligarchs are being shunned from the system, is what is their alternative route? Even though they have amassed $600 billion in their coffers, they still can't transact with it. Unless they take suitcase and move the money, which doesn't happen. So money never leaves the country, as you know. Money, unless it's going in a suitcase, which is illegal, more than $10,000. But to answer your question, this whole element of allow and deny list can also happen at the endpoints in crypto world. But the crypto world itself is completely oblivious because its entire thesis is censorship resistance. You shouldn't have any single entity, which means that I'll stop here. You had a follow-on question.
I'm not sure whether that's related to what I asked because I'm typically like asking regarding blockchain. So blockchain, like there is a series of events when if suppose you have to change one particular, you have to alter something, then you have to go back and change that.
Yeah.
So in SAP, there is manual interference, right? It means someone can allow or disallow.
Yeah.
But in blockchain, is it possible?
Yeah. So
because
Bhagat, you want to ask the question?
Yes, so you can actually define all of that in business logic. You can give different roles and different authorities to you.
Yeah, that's what I'm saying. So
Yeah.
that means
Only in permissions.
In current SAP and the blockchain. So what is the difference then?
Yeah, so let me answer a few things on that. So in permission world, or let's say blockchain in general, you have what we call participants. Participants, as you may know, may be nodes. People bring their machines to do mining, or validators in case of proof of stake, or you may have wallets. These are all different classes of participation and people who have different business models behind this. So what happens in the world that you live in, so as long as transaction hits this, it'll go through the system. So the moment you submit a transaction, it finds the mempool, it adds itself to the block, somebody has to validate the block, blocks go to then you can't, it's unstoppable at that point. You cannot go and intervene in the mempool because that breaks the tenets of the censorship resistance and transparency and everything else. So what ends up happening is, if you devise a business system on top of this, so these are institutions who have a node. These are your existing control mechanisms to say, before I actually build this, and I'll give you an example of how I build it. You can have a mechanism to say, before the transaction hits the chain, I'm going to do all these 4 or 5 things. So I built up, and you should Google this, IBM WorldWire, where we use something called Stellar, because Stellar was a payment network designed only for payments. That's all they do. So Stellar, Ripple, and there are Cello. These are projects who are designed purely for payments. So why would I not think about payment? Because the underlying net infrastructure was designed to move money. So what we did was we built, again, do you see this little layer? We built this layer, and this layer was called WorldWire. And what we did was we had 2 control mechanisms. We call it white label and trust lines. So for me to transact with you on a network, even though we're on a public network, if you're on WorldWire, then we'll onboard you. We'll give you a wallet, which means even if you leave us, you can still have the wallet that you can transact in the public world. But if you want to transact in our ecosystem, you have to allow for trust lines. So I trust you, and we have a contractual obligation, so you cannot deny what you did do. And we have to do something called whitelisting, which means I'm willing and able to accept an asset that's issued by you. And we gave, which means if you don't have trust lines, then you could not even talk to each other. Forget about transacting. But if you had trust lines, then I can process messaging transaction between the two. For me to accept stablecoin-like assets, I need to have whitelisting. So that means that I'm taking some accountability, some responsibility. And you had an admin process in place that could turn off and on at the enterprise level.
Basically, all the due diligence and
Happens before outside. I think. So if you look at this here, right? So you see these enterprise systems? These are your existing SAP, Oracle financial systems and like stuff. All you're doing is basically saying, I will, and this is another thing you all should know, is that in the enterprise world, there is trillions of dollars of soft money and business processes that has gone into building these systems. They're not going to replace that because blockchain is cool. And there's a lot of control procedures. So the question then becomes, how do they coexist? And how do we make sure that the same business rules and processes follow through in this world? So my profession in terms of to the industry is let's figure out a parallel lane which allows us to use this only as a transaction processing system. And we can figure out the flattening of business processes later. So we have two paths. Either we work on this existing path and build a parallel system and eventually merge them, or build a layer which is a patchwork which still does approvals and everything else and relies upon existing controls, existing things, and uses blockchain as a transaction system.
So are there any examples like currently SAP is collaborating with like blockchain technology?
Yeah, SAP joins Hyperledger for that reason. Because an SAP will, just like mainframes, SAP will be there when your kids are born and they are getting married and everything else. It'll be the new mainframe next generation. They'll still be a significant part of this entire ecosystem, except that the disruptive forces who are coming. There are many projects who are working on supply chain. So there are projects who are providing you solutions, not selling you tech. So SAP is selling you tech. But now you can join a network and say, this is trade finance network. Let me just join the network and I can use that as a trade finance option. This is a trade logistic network. Let me join this and be able to track and trace my shipping containers and all these things. So you are basically giving a turnkey solution. That's no longer about building a software project. It's about onboarding and offboarding and joining a network and beginning to take advantage of what the network has to offer from a tech perspective, but also from the ecosystem point of view. That you're joining a network. So no longer is a software development cost issue, it's a transaction cost issue which fuels the ecosystem that's keeping the system up. So yes, it's a cost shift focus, if that makes sense.
But in an enterprise or intra-enterprise transactions, isn't it like force-fitting blockchain to?
It can be, and that's a great point because for intra, when you say intra, you mean to say in company, right? So we did this with Bank of America, Scotiabank as truly global systems. And this is all, again, all in the open, right? Is truly global banks have a problem. So if you have like State Bank of India has branches in Dubai, they have branches in India or in US. And they have to maintain liquidity, keep the cash in reserve in these banks individually by the local mandate, by FATF guidelines, Basel III, Basel IV. These are all global standards that require as to how much liquidity you have to maintain in these banks. And our assertion for transforming the system for intra-bank transactions is even though you are part of SBI umbrella, which is number 48 in the overall global banking ecosystems and asset under management, that instead of you maintaining liquidity in Dubai and in Abu Dhabi and in India and maybe in London, if you can move money at the speed of wire, can you not move liquidity where it needed the most? So you have pooled liquidity, like an omnibus account, what Citibank uses to. So if you're using Zoom to move money, does anybody move money outside of India here? Once in a while. So what do you use? No, you as an individual. I don't think you have access to SWIFT as an individual. Like you as an individual, what do you use?
I received it from Swift.
Oh, so from your bank then. Somebody had to wire.
Yeah.
Oh, yeah, they must have paid a lot of money. But I did experiments. I do all the time, and I've lost a bunch of money, but you learn a lot from it. You can send money to somebody in Pakistan. Not going to happen here, but I did that from the US, and it's just lost. I just can't track it. I used Zoom to send money to a cousin in India, and it was done in literally instant. Zoom, XOOM. It's bought by PayPal. And I'm giving this example because of the question you asked. So Zoom is bought by PayPal. PayPal is it's not a bank, it's a payment company. They do work with bank. They built an omnibus account, and they tied to all RTP system, real-time payment system in the country. So when I send money in dollars from there, They take $2.99 per transaction, cheap as hell, because back in the day I had to pay percentage of money you're sending. They take $2 for transaction, and they send the money to the local PayPal account here. Their own account. They're not a bank, but they have an account on UPI, right? Money has never left the country. They've realized this money here. They have to keep piling liquidity depending on the flows as to keep piling liquidity here, because they bank with some bank that has some relationship with some bank and central bank. But at the ground level, they have used their liquidity in country to facilitate real-time payment, making money off a spread, even if they make a rupee on every single dollar. That's quite a bit, plus $2.99 for transaction fees. But the money was here within a matter of 2 minutes, like completely end-to-end in 2 minutes, which I think is fantastic. Of course, there's a limit. You can't move like $1 million using Zoom.
That's not intra-organization transaction.
Correct. My point is PayPal is intra. So PayPal that is a closed loop system. Amex does the same thing too. Between a bank that may have a liquidity function in different countries, there's still intra-bank communication. So you can have a cash flow system between treasury management, cash management, liquidity management. These are all different functions, and they have to reconcile the book. That's also intra-bank. So you can look at intra-departmental or umbrella of banks, which can use blockchain, but the one thing in my experience has been that the cost of integration is exponentially higher than the cost of tech itself. So blockchain is cheaper, but if I use blockchain to process transaction, which today relies upon batch processes and Swift and internal ACH or like ANZ, for example, many of the global banks use Swift messaging, but they don't hit Swift. They use their own internal network for messaging transfers to move money, only because Swift is expensive for intra-bank transfers. Does that make sense?
For banking system, it makes sense because there are multiple stakeholders involved.
Correct.
For an organization like IBM, for example, if you just want to maintain sync across all of its offices.
Yeah, we tried. Trust me on this. We tried with Treasury, didn't work at all. We went with global IGF, I mean global finance, because we have about 9,000 vendors. So when you buy a solution from IBM, we do financing. Just like when you buy a car, you get financed. We say, give us, and that financing has to deal with business partners, and they have to deal with the different hardware solution providers. So if you buy an IT solution which uses Cisco and Dell, we'll still finance it. So all that is there. And we tried to create a system with 9,000 vendors. Didn't go anywhere because you had to have all 9,000 people on the network. Inside of IBM too, like having IGF or our Treasury take from systems group and different business units, didn't go anywhere. Just as an experiential matter. It can be done, but I think the cost of disruption was way too high for a bank. And there's no, like to me, tech could be cool, but the thing is that if there's no motivation. So why are banks and institutions getting into crypto right now? Because they begin to see the disruption. Internal, there's no disruption from your internal. So there's a motivation that's not there too. So no one's trying to save money from processing less transactions like what we would do or reduce cost. But the disruptive elements become a motivating factor for many of that's why financial services is the first industry to go all in, because the margins are high. They've been constant threat with fintech. So for the past 10 years without fintech threat, suddenly you have crypto threat. And fintech companies have become crypto companies. So it's like a double whammy for these industries to say, we absolutely have to change this old financial system, whether we go the fintech route, which is digitization, or we go down the tokenization path, which is crypto. One way or the other, got to change. So the question is, which poison pill do I take, a blue pill or a red pill, which is fintech versus crypto? And oftentimes the lines get blurred because crypto is also fintech.
It's easier to start from scratch than change the process.
Correct. One last slide before we go to Web 3.0. Typical path, and this has worked for me. I've done like 12,000 POCs. I'm not doing POCs anymore. And I suggest that if you're asked to do POCs, just walk away from it, because POCs never fail. They're controlled experiments. They'll always succeed. So if you're doing marketing bang for your buck, then go for it. But POCs I don't do. So we begin to look into identifying use cases. And this is part of the syllabus or the conversation here, is figuring out identifying a use case. And I was told that this is a graded class. Is that true? You guys were told that too? So how do we grade you guys on? Class participation is 1. I'm just kidding. But there'll be some test, and we have to figure this out. But the point is we have to identify a use case. So remember the trait, trust, ownership, trustless. At the end of the day, I'll give you an assignment. Tomorrow we'll discuss the assignment. Come prepared with it and have logic, have a conviction. There's no right or wrong answers. As long as you believe in it, it's all good from that perspective. But the whole point is trait, trust, ownership as tenants, time and trust, permission versus permissionless, choices of technology, choices of the factoring of these tokens. Is some of the things that you should think about when we talk about the assignment that we'll give this evening. But main thing is identifying a use case, and that's a big point, which means that what am I solving for? So to your point of enterprise, what am I getting from it? Like, if I can solve a database, that's a well-known tech, let me not do that. And then you've got to figure out the business blueprint, which as a technologist, it took me almost 4 years to put this in front of this, because everybody was quick to do a POC, not realizing that you have all these business systems running in the place. So business blueprint is how is existing business process distilled? How is that affected or being affected with this new tech that's coming into the place? And if the disruption is because the fact that it's all IBM, my company, for example, it's an old company. We have really old systems. And so the question is, and this is true for banking too. So most banks are going through this ISO 20022, which is a payment modernization agenda. Suddenly you start bringing stable coins. Well, the entire organizational energy is on modernizing a payment system. Now you want to have ADHD say, hey, we have crypto here. It's like, no, let's finish this first. So there's a business blueprint challenge of who's willing to pay for it? What is the motivation? What's the disruption? And is this truly disruptive? So the answer may be different for Amex because they're dealing with card payment. And who do you work for again?
I'm into the academic side, not the investment.
She's a teacher.
That's fine. Who do you work for? You can still be a teacher and work.
I work for this.
Oh, you work for this place. Okay. Well, then we'll hold the questions back for this. But the point of the business blueprint process is, if you're working for a bank, for example, then are you working for payments? Are you working for securities? Are you working for liquidity management? What is your agenda and what is it solving? So most internal projects don't go anywhere. You have to have a focus, and in most cases, nobody wants to build a consortium. You may have seen that with your. It's the hardest thing to do is to bring 5 banks together to work together. Well, they'll never work together. There's competitive elements. There are data issues, all kinds of issues. The question is, everybody wants to join a network. So the decision of choosing a permissionless model, on-ramp, off-ramp, is the easier one than saying, let's bring all these banks together and work. And I have failed miserably trying to do that over and over again. And not just for bank, but supply chain. And I have stories and stories of the trips I might have made to Hong Kong in a year, like 7, 8, 9, 10, 12 trips with no results, for example. And then you come up with the technology blueprint. This is where we choose things like what we discussed earlier, which blockchain, permissionless, cryptography, do we provide integration with SAP system, Oracle systems? And then you have to deal with, which is the most expensive part, is enterprise integration. That's true even for, so it's easier for the new crypto companies to come to business because they have no burden of legacy. You start fresh. So for example, Firoza, you'll have no problem adjusting any of this stuff. You're starting with a blank slate and you just simply get in and you choose your path but for folks who are switching lanes, it becomes incredibly hard to figure out as to what you want to do. So enterprise integration is the most expensive part of this whole journey. And so keep this in mind as you're designing for today's sort of homework. And I had a question which no one answered. Why do you see so many crypto companies pop up overnight? Literally a day or a dozen a day. Oh, that's one answer, tulip mania. Tulip mania is the answer. Huh? Oh, okay. FOMO? No, I just think.
It's a different sort of tech which is not been explored yet, and so now every field wants to go in that field, and that is why applications are coming through from all different fields, and each of them is trying to integrate blockchain.
True, there's one aspect of it, but my theory on this is it's copy and paste. I mean, Pancake Swap and Sushi Swap. These projects rely upon open code, open governance, open models. So Uniswap and I think Uniswap and Pancake, then you have Sushi Swap. You have all these food bento boxes and everything else. It went on this whole food theme. But basically, some of these projects said, okay, you know what? They have spent a year. Some projects. So Uniswap simply took the code and, SushiSwap took the code and was in cut and paste the code and change the name and change a few refactored the code. So there's a little bit of that it's open governance, which means it doesn't take a lot of skill for you to build a business on crypto industry, because you can take a bunch of ideas from all these different areas, and the code is open. There is no, and this is why I think patenting, I have 160 patents in IBM for blockchain, but I always question sometimes is, it's an open world. How do you go after IP? Who are you going to go after IP? For the decentralized system, you're going to sue a node. Who are you going to go after infringement of your patent? So everything is being opened, like in an open source ecosystem, open source environment. And that is a little bit of mind shift, that the intellectual property as we know it in this room, like some people have told me the SmartPoint is intellectual property. I said, I don't think it is. I mean, intellectual property has this bit more intellectual, that you can read PowerPoint, but you can't think like the person who wrote it, right? So the code becomes intellectual property. And if that's open, if that's can be copied and replicated, then what is your gating criteria? Can anyone answer this question? And if you answer, then you're passed and you don't have to worry about any more assignments. That's going to be IP. So I can copy the functionality too. Every time you make an update, I can just copy that and have the same functionality in my Uniswap code too. But if I'm so SushiSwap and Uniswap are both DEXs, decentralized exchanges, which we'll spend some time more on this. So they're the same thing. It's apples and apples, exactly the same thing. Critical mass. How do you achieve critical mass? So there was a time when SushiSwap did better than Uniswap. So Uniswap had to do something to fix that. So yeah, you have first mover advantage, but that's a very short-lived thing, because you have the project that launches, you do well, somebody else copies it, and you have the ADHD in crypto world. Like, look, that's a cooler one. So everybody moves there. How do you make your platform sticky?
In finance, we call them economic modes.
Yeah, that's right, economic modes. How do you build economic modes?
So, like holding more, I'll say, by giving more, by putting in more liquidity in a particular platform, I guess that will make it sticky. Like I use Uniswap because I've already put some money into that. Suddenly.
Modes and community. So Shreyas, I have learned that liquidity is your favorite term. You just happen to use it everywhere. Every question we talk about providing liquidity. So liquidity is your favorite. I get it. I'm just joking, but so liquidity to me is secondary, right? It matters. Like any marketplace needs liquidity, and you have market makers, and market makers like Akshat mentioned that that it depends on the community that you build. So the more and more market makers you provide, and if you're comparable, you'll attract more and more market makers to that community. So to me, it's like, a bank would want to open a branch everywhere they can find accounts. It's not necessarily competitive advantage, and they will provide liquidity if there's business there into it.
So I think it's the kind of projects that the platform attracts.
Okay, so ecosystem. Okay. So I'll use the word attracts in parentheses, and I'll get to it in a minute.
Collaboration.
Ecosystem, communities, collaboration. I can add idea. There's a one term for all of this, so I'm writing this down.
So basically how I see it is, since there's no patent and everybody can copy what you do, basically you have to be at the forefront and you have to keep doing the best.
Well, that's a very generic statement, though. No, that's true. But you could be your best, but still not be unique, still not have the community, still not like best technology rarely wins. I get your point. It's like saying I got to work hard, but yeah, no kidding, you all have to work hard.
In community itself, like the higher participation that you have.
Yeah. So how do you build a community? That's my point. So there's one word I'm looking for. If you can name the word, we'll stop the conversation right here.
Can you relate it to smart contracts?
What?
Can you relate it to smart contracts?
Well, smart contract is just a construct which enables all of these things. So smart contract is a technical artifact that, as we discussed earlier, we discussed smart contract basically, it's a programmability component,
Right.
which gives you the ability to have business models, the DAOs, and
For
everything else.
prediction gives you evidence for it that the things happen. So that's why maybe you collect it through that.
Yeah, but you have to do, like, smart contract, good or bad, worse, shitty, is this, you have to have smart contract in some cases, right? So my point is, we have to be on the forefront, work hard, smart contracts, given, that's the table stakes. And community building is needed, so we take a step up. You need a tracked ecosystem, absolutely true. There's one word that I'm looking for. Starts with a T. Something else. Yes, who said that? You get a free bottle of water. That's yours. Where did he go? He went for lunch? He was supposed to, oh, he had a banana. Okay, tokenomics. So tokenomics is it. To me, if you're into new projects, I look at this a lot lately in terms of sustainability of a project. So gaming, who are here from gaming community? You're from gaming guy. I expected you to come up with an answer like the first question that I asked. So gaming community, your digital, like this is hard for you guys for digital marketing, because how the hell, this is the same challenge you will have that I had with corporate world and building consortiums to build tokenomics in an enterprise. Because tokenomics is really all the things that we discussed, right? You need to attract ecosystem. So to attract ecosystem, why will they come to ecosystem? Well, they're getting something more valuable they won't get somewhere else. So how do you have how do you create the moats, but at the same time have enough pathway and gateways to cross those moats so you can benefit from it and provide the stickiness? What is the community? Just wallets, having people open accounts, which is what banks have done for ages. How many accounts do you have? That doesn't necessarily translate. And I think Wells Fargo, as you all know, public information, signed up like 500 million people for credit card they didn't ask for because they were incentivized for creating accounts. So having wallets doesn't cut it. And you need to increase transaction volume. Why is that? There's a direct relation between this and this. Tokenomic system, if you're building a new project, especially gaming, I would spend all your energy on this. Don't spend on your POCs, don't spend energy on which platform to use, you'll figure that out. I focus on building a right tokenomic structure, and there's a triangulation element, which again, we'll discuss today or tomorrow, is spend all your energy on this, and not on tech, not on which platform to use, not on which token to use, this is what bigger mistake people do is, how many tokens do I start with? But that's not tokenomics, that's just supply. So figure out and there's a 3 Venn diagram for those things where this is the sweet spot you want to be in, and each of them represents something which I'll discuss later on, but the whole point is tokenomics for gaming people. And for you guys, Nike, as you know, bought a company called Artifact. Have you heard of that? Artifact, RTFK or something. That was like interesting company. And Budweiser got Bud ETH. Visa went and acquired NFT. Some of that is marketing pitch. But for you to be able to enter a digital marketing space and compete with the crypto native companies who are building NFTs, you can acquire all the companies you want, but it's incredibly hard because they have what we call as participative system. Hallmark of Web 3.0. I'm going to stop here and go to move to Web 3.0. Any questions so far? Does it make sense though? Like, I think digital marketing, NFT and metaverse is all about digital marketing. And I have spent literally last 8 months understanding this space, and I don't have a point of view yet because it takes time to understand this. But I see a lot of like FUD factor at the moment, fear, uncertainty, and doubt. And so therefore, let me go invest and figure this out. But I think what organic development of that will be a better option than simply acquiring or putting your virtual shoes in some metaverse and calling yourself, which is what JPMC did. JPMC had have you heard of the guy? I think they had a lobby in metaverse. So JP Morgan had a lobby in metaverse and they called it like we're banking in metaverse. I said, no, you can't. I know you can't bank in metaverse today. For all the reasons, right? There's no ID, there's no element, how do you deal with that without a proper traditional bank that doing that stuff? So a lesson in mind as you're going this journey, look into those models. And these are 7 design principles. There's a paper behind this. I would look into this from every project that I design. Look for 7 things. And the reason why I want to do that, because just like today's conversation, which I had a plan, and we went in different route because it is more important to address the curiosity than going through slides, is that crypto conversation can go in all different directions. There's a lot of ADHD and lack of knowledge in this space. So having a design which says, I'm going to stick my conversation to these 7 things, like my design should meet the 7 criteria. Otherwise, you're failing in your duties. So to me, I look into saying, I do have to provide control to participants, whether it's permission or permissionless. So I can remove my wallet, remove my node. In permission world, I should be able to exit out of the permission and still have control on my transaction that has transpired. Provision for an extensible network, flexible membership, adding membership, removing membership, changing economic models. How do I deal with those elements? Permission for but protected networks, protecting competitive data. So most of you may work with corporations and large entities. How do you protect all the things that we were discussing earlier with homomorphic encryption and anonymity, open access and collaborative global networks? These last 3 are technical challenges. I do have to deal with security, scalability, and coexisting with existing systems, which is the most expensive part. I have the 7 principles because they were simple. I wrote a paper on this topic, and I think that this helps us keep the conversation real and pragmatic. Otherwise, you have all this out of possibility conversation which doesn't go anywhere. So those are the few things that you should. So I'm going to move to Web 3.0. Are you okay so far? Does it make sense?